Good afternoon, everybody. Welcome back to FAST CPAs and Consultants. As always, here we are with our CPA, Fulton Abraham Sanchez. Hello, Fulton. I hope you're fine.
Hi, Monica. How you doing?
Fine, thank you. Excited for the topic of today. So let me explain what we are doing. So for the new ones, this is a video series called Tax Talk, where we talk about the different tax strategies that you must follow according to your situation. How do we select the topic? We'll receive your question through our social networks, which you can find you can find in the description of this video. Today's topic is about tax deduction for real estate, specifically tax deduction for rental property. So Fulton, let me start with the first question.
Go ahead.
Which is, what expenses are tax deductible on rental property?
All expenses that are related to the rental income activity. This is taxes paid for the property, mortgage interest paid for the property, any commission that you pay for the renting, for looking for a tenant and for renting out the property, any repairs up to, or any maintenance or repairs up to $2,000. Anything beyond $2,000 needs to be depreciated, meaning it cannot be expensed out. Anything that is cleaning, related to the cleaning of the property, to the maintenance of the property, to the repairs of the property up to $2,000. And also the depreciation. This is key for the reduction of the profits of the company. Many times what I've seen, what property makes, when there's property and mortgage interest, there's mortgage interest and expenses for repairs and maintenance, the depreciation makes the activity of the property either reduced with a reduced profit or with a loss. That helps the tax position for that for the investor, for the owner of the property, because with a lower profit or with a loss, there is a lower income that is going to be taxable. But they have to be careful. Remember that if you take depreciation, the depreciation is not something that, it's only a tax deferral. In tax argot, it's called a tax shelter. It's a temporary reduction of the income from the rentals that you have, because when you sell the property, you have to retake that depreciation, meaning that that depreciation is going to be in between quotation marks income for you, because if in the previous years, it has been an expense. So it has been reducing your rental income because you have taken depreciation. When you sell the property, the depreciation is taken back, is retaken. You have to retake the depreciation with the objective of calculating the tax basis of the property. So we always advise our clients, it depends. If you plan to keep the property for the long term and then give it the title to your inheritors, to your children, then it is okay to depreciate the property. But if you're gonna sell it after 5 years, 3 years, 5 years, then it is a good idea not to depreciate the property, because when you depreciate the property and you sell it within 5 years, you have to retake the depreciation and your capital gain is going to be higher. You still have the advantage, as we explained in a previous video, that the capital gain is taxable up to 20%. But still, remember, any dollar of depreciation that you take when you sell the property, you have to take it back. Not anymore at the current tax rates, at the maximum tax rate that you might have, but at a rate of capital gain of 20%. So that's the advantage of having this tax shelter, that is depreciation.
Understood, that's clear, thank you. And what is the maximum deduction for rental property?
There is no maximum deduction per se. There is no fixed amount of deduction. Then it will be like a word of caution is, unless you have income in 1 year, all of the income of that activity is subject to expenses. You can expense out up to the amount of the rental income, except for depreciation. When there is depreciation, then you can use depreciation and the amount of the expenses will be larger than the income. But there is no like a formula that, let's say my income is 100 and then I can only deduct 50%. No, it's any real expense related to the income produced from the rental. So if you one day go and have lunch with a friend, you cannot use that as an expense for the property because it's not related. Even if you take, for example, the realtor, or you take the person who is doing your maintenance for lunch or to have lunch, that will not be depreciated because it's not related to the activity of the property, of the rental income. So even though there's not a formula, second word of caution, whenever there is no income in the property, you cannot deduct expenses. There is no deduction of expenses unless the property is reporting rental income. We always advise our clients that whenever that is the case, that they use those amount of expenses as an accumulation of expenses for the next year. When the property is going to produce income, they will be able to claim that as a deduction. In that case, will be an amortization to be amortized within five years, or depending on the amount, you might deduct it in a full year. But it all depends on the income of the property. If there is income, all the income of the property will be expensed out. If there is no income, or up to the income of the property will be expensed out. If there is no income, then there is no expense to deduct.
Got it. And what expenses are allowable against rental income?
It's every single expense that creates the rental, that allows to create the rental income. For example, for making the income, for earning the rental income, you have to fix the property. You have to repair the property. If the property is not occupied, you have to hire a realtor or commission a realtor for the rental of the property. That commission will be deductible. You also need to fix the property. You need to make repairs. You need to pay the mortgage. You need to pay. If the property needs inspection, you need to pay the inspection. All those expenses that are tied directly to the production of the income are deductible. There are cases, for example, when you have to fix the roof, you have to redo the roof of the property. That is an additional value to the property, will need to be depreciated. That cannot be expensed out. Large expenses, less than $2,000 are not expensable in the year.
Okay, understood. And why is my rental property loss not deductible?
Because as we said in another video, there is a passive activity. All passive activities have a limit of deduction. And the limit of deduction, as I said before, is the rental income. The rental income that the property produces in 1 year, that is the maximum amount for deduction, except for depreciation. Sometimes when depreciation is present, and most of the time when depreciation is reported, is going to create a loss. But in terms of why the loss is not deductible, it is because there is a limit for that passive activity to the income of the rent, the income coming from the rental activity of the property. The loss is not deductible because the expenses are only deductible up to the rental income. Anything beyond that will not be deductible. That's why the loss is not deductible. Though, when the property is sold, all these losses, non-deductible, that will be accumulated through the years will be in one shot deductible at the sale of disposition of the property. At that point, when the passive activity is completely disposed, the loss, all the losses or the losses accumulated through the year will be 100% deductible.
I see. And here's a question that, yes, you have already mentioned the answer. Can I deduct depreciation on rental property?
Yes. Yes, you can. But again, remember, there is the limit of the rental income. If you keep reporting losses from a rental property, you risk to be audited by the IRS. Because remember, when you have an activity, any activity, when you have a business, either active or passive, active like selling things and giving your services, providing your services, or passive like rental activities, you are supposed to make money. Otherwise, why you buy the property? There are cases where the losses are legit. They are real losses, and many times when they are in an LLC, you can take the losses. But remember, whenever you sell the property in the future, those losses will be taken back, and that is going to increase the capital gains that you have to pay for the property that you are disposing.
That's clear. And how can I avoid paying tax on my rental income?
Taking the full amount of expenses, all the legal expenses and the depreciation, and perhaps after taking all the legal expenses and the depreciation that are allowed to be deducted from the rental income, your profit will be minimal, or will be that low that will not create any tax. But if your property is creating profit, the rental income is creating profit, there is no way that you can avoid taxes.
Got it. And what happens if you don't report rental income?
At the moment of the sale of the property, the IRS is going to receive a 1099 from the company that does the selling. It's called the closing agent. The closing agent is going to send a 1099 form. We talked about this in the previous video. The closing agent is going to send, it was when I was talking about the FERPA. In that video, we said that the closing agent is the one dealing or doing the intermediary activity between the seller and the buyer. And this closing agent sends a 1099, will send a 1099 to the IRS for the sale of the property. And you have to report that sale. So at that moment, if the IRS doesn't, this is not someone reading the financial, the tax return. This is an automatic system that is going to do a comparison between the 1099 form that you receive and the closing agent sends to the IRS, and the report for the rental income and rental expense that you have through the years. If there is no matching, then the IRS is gonna send you a letter, and you will be good for an audit to claim all that income that you didn't declare. Now, there are times that because of the depreciation instead of income, you have losses in a few years, in a number of years. That will be your defense. But it will be better if that is the case, that you hire a seasoned professional in real estate taxation, for income taxation, to act before the IRS. This is an attorney, a CPA, or an enrolled agent to defend your case.
Got it. And how much rent is tax-free?
Nothing. There's no rent tax-free. All the rent is taxable. If you make it's income, all income is taxable.
Okay, and we have the last question of this video. Do I pay tax on rental income if I have a mortgage?
Yes, you have to pay taxes on rental income, of course, even if you have a mortgage, though the mortgage interest works as a deduction that is going to decrease the amount of the income rental that you received, and therefore is going to reduce the amount of taxes you have to pay.
Okay, I got it. Well, those were the most important questions we received, and yes, about tax deduction for rental property. Thank you for joining us. Thank you, Fulton, as always, for your time. And remember, everybody, to follow us on our social networks, like in Facebook, where we have an exclusive group. Trust me, if you are watching this video, you want to be in that group. So you have the link in the description of this video. And before leaving, check if you are already subscribed to our channel so you can be notified when we publish a new video about taxes. Thank you again and see you in the next video. Bye-bye.
Thank you. Bye.